You guys could turn on your cameras. I'd appreciate it. Of course, I leave the choice up to you, but. Okay, folks, welcome back. I see a few familiar faces from the corporate finance class, and I'm sorry to put you through two Zoom classes back to back. But this is just for those people who are in my corporate finance class. I know you probably noticed that up till now, the two classes seem to be operating on pretty much the same wavelength on betas and equity risk premiums and cost of equity. Today's class is when the two classes will diverge. So if you think you're getting the same stuff twice over, I apologize. I need to do that just to make sure everybody's on the same page. So just starting with this class, expect the material to kind of diverge because we're going to be moving in different directions. So today's class, we're actually going to start talking about cash flows. And what I'd like to do is start this discussion like we always do with the start of the class test. So one of the big issues you face when you value a company is you want the most updated information you can. Why? Because you're going to be investing today, not at the start of 2024, not at the start of 2023. So you want the most updated numbers you can get. For market numbers like T-bond rates and even implied equity risk premiums, that is easy to do. You can update the number, you can get today's number. But a great deal of the information you need to value companies comes from accounting statements. Income statements, balance sheets, statements of cash flows. And accountants don't update their numbers every single day. They don't even update them every week or every month. In the US, they usually update them every quarter. In parts of the world, they update them every 6 months, and in some parts of the world, only once a year. So you're facing a challenge. Your numbers are all mismatched, right? Your T-bond rate is as of right now. You go pull up your annual report. For some of your companies, your most recent annual report is going to be as of 2022. So I'm going to actually pick on somebody and hope they picked a company. Matt, have you picked a company yet?
Yes.
Who did you pick?
Snowflake.
Snowflake. The most recent annual report, 10K come out, or is it you're still waiting for it?
Let me see. Looks like I'm still waiting for it.
Okay, so your
Last
most
one's
recent
3Q.
10K is 2022 10K then?
Yeah.
So you're sitting to value a company today. The 2022 10K is obviously an old one, and especially with a company like Snowflake, where so much can change in the course of a year. You don't want to go with that 10K because it's going to be old. So when valuing a firm, so let's look at the choices. You can go with the last 10K, but for Matt, that's going to be more than 11, 12 months old. No, maybe even 14 months if you think about the end of the last year. Can you take the most recent earnings report, which for Snowflake should have been through the third quarter numbers through September? Can I multiply that by 4, Matt? Do you think that's a good idea? Why not?
Because their growth is so high.
And also you got seasonality, you got strange things going on. You don't want to multiply by 4. So that's not going to work. You can add together the earnings for the last 4 quarters, which would be the first 3 quarters of 2023 and the last quarter of 2022. That's called trailing 12-month numbers. That's in a sense the most updated accounting information. Or here's a fourth choice. You can take the first 3 quarters of 2023, where you have the actual numbers, and try to estimate the numbers for the last quarter of 2024. You can try, but here's the challenge you're going to run into. They might update, you might get updated numbers for revenues and earnings, but you're not going to get updated numbers for the rest of the stuff. So I'm going to try to answer this question myself. You don't want to use the last 10K because it's old, but though for some of you, you'll get lucky. If you're doing NVIDIA, your last 10K is just 1 day away, right? Because today the earnings report comes out, you'll have the 2023 numbers. You might have your last 10K might work if it's updated, but if it's not, use the trailing 12-month numbers. As a general rule, when you value companies, go with the trailing 12-month numbers. They're the most updated numbers you can get. Let me pause right there. Is everybody comfortable with that idea of using updated? It's called LTM, last 12 months. Most services now report that as a separate column. It's easy to get. It's the most updated number you can get. See? And even if your annual report ends as of December 31st, 2023, remember your value is of today. The fact that it ended as of December 31st, 2023 doesn't mean you're doing a valuation as of January 1st, 2024. It's always today that you're valuing the company using the most updated information you can. Okay, Justin, go ahead.
Where would we find the trailing 12 months?
There are 2 ways you can do it. One is if you can get a 10K and a 10Q for your company, an annual report, the most recent quarterly report, you can construct it yourself. Okay. The second is if you go to S&P Capital IQ or even Yahoo Finance, they usually have an LTM column, a last 12-month column. So if you look at the financial statements, they'll often report the last 12 months. I'm not sure whether Yahoo Finance does it still, but it used to. So if you can, most places where you go looking for data, there'll be a last 12-month column now. But Capital IQ definitely has it, and you can always construct it yourself with one 10K and one 10Q.
That's what Capital IQ is doing? They're just amalgamating
exactly.
the Q. Okay.
They're taking the last 4 quarters. So the LTM in Capital IQ is the last 12 months.
All right.
Here's the second question. I don't know whether you remember your accounting, but my accounting professor made a big deal about how in accounting you classify expenses into 3 groups. You got operating expenses, expenses designed to create a benefit this year, capital expenses that create benefits over many years, and financial expenses that are expenses associated with the use of debt. And that's how you frame financial accounting, right? So if you have operating expenses, they show up in the income statement in the year in which they happen. If you have capital expenses, they get depreciated or amortized over time. And financial expenses show up below the operating income line. And accountants claim they're consistent, but they're not. So to illustrate the inconsistency of accounting, I'm going to ask you to think about what capital expenses are. They're expenses designed to create benefits over many years. And I'm going to list out a series of expenses, and I'd like you to tell me whether they fit the definition of capital expenses. The first is a manufacturing company like Tesla building a new plant. Does that fit the requirements for capital expense?
Yes.
Okay.
Yes.
It's a slam dunk, right? What about a technology company spending money on R&D?
It depends.
Yes.
It depends on the accounting system that we're under.
Forget about the accounting. Just think in terms of what the accountants themselves told us. Accountants told us capital expense creates benefits over many years if you stay true to accounting first principles, not to rules, but to first principles. Is R&D a capital expense or an operating expense?
The capital expense.
Yes, but it
It's a
depends.
slam dunk. It's a super capex, right? Who does R&D expecting to get a benefit this year? We'll come back and talk about how accountants screw it up, but that's a different problem. It is clearly a capex. What about a company like Coca-Cola, which gets a big component of its value from brand name? Could a portion of advertising expense, no, remember, some of advertising is designed to build up brand name. It's not to get you to buy more Coca-Cola this year. Could some of it be CapEx? I don't see why not, right? You're building up your long-term assets. Rahul, you had a question?
Yeah, my question was if it's a tech company and it's an R&D expense, wouldn't that count as like cost of goods sold, which would be considered?
That's what accountants do. So you're pointing out that accountants are not being true to their own first principles. We'll talk about what dance they do to justify it, but it makes absolutely no sense to do what they're doing right now. In fact, across the world, most R&D is expensed. It's not capitalized. I'll give you the weird logic that accountants use to justify it, but it doesn't make sense given their own first principles. It should be a CapEx, as should some advertising, as should be recruiting and training expenses for a Deloitte or an Accenture or a Goldman Sachs, because human capital is your biggest asset. Accounting does a horrifically bad job in classifying operating and capital expenses for companies that are not manufacturing companies. And in a way, in valuation, we face the residue from that bad behavior. We'll talk about what to do today to fix that. But clearly, these are capital expenditures, should be treated as such. So we'll talk about that towards the end of today's session, but let me close this up. And can you guys see my page, or should I stop and reshare?
Yes, we can.
Okay, you can see it. I left you last session with why I think a single regression beta is a terrible way to think about betas. Mallory, you want to remind me what the problem with running a single regression and getting a regression beta is in a calculation? You can pass if you want.
Sorry, I'm in the quiet room.
Okay, sorry. Okay.
So
Definitely pass. Melissa, you want to tell me what's wrong with running a single regression of a stock returns, which is the way we're taught to do betas? What's wrong with a regression beta?
Oh no, I'm gonna have to take a pass.
Melissa Scherer, there are two Melissas. So Melissa Scherer, you have two, you're showing up twice on my thing, or it's two people with the same name, so it must be twice the same thing. Never mind. How about Matt? Matt, you want to try? What's wrong with the regression beta?
I'm also gonna have to pass.
Nobody wants to try?
I'll give it a shot.
Give
It's
Okay.
backward looking, and it does not represent the future. It does not represent the future.
It might not represent the future. It's backward looking, so it reflects your company as it used to be. Everybody agree with that? Regressions have to be backward looking because you have to use past returns. And if your company's business mix is changing, its leverage is changing, it will not be a good forward looking map. That's the first problem. What else?
I'll give it a shot.
I'm sorry?
It can also have a lot of error.
It's noisy. It's got a high standard. It's statistical problem.
Yeah.
It's noise. And any other?
It's got a lot of error which cannot be applied.
That it can be manipulated in the way
that
that
can be gained, right? So for those reasons, I wanted to bury regression betas. But I then gave you an alternative, and we were starting on the alternative, which is rather than use a single regression beta, I said, break your company down into businesses, get the beta of each business by looking at publicly traded companies in each business, and then take a weighted average. How does that solve your problem? First, an average across hundreds of companies is more precise than a single company's beta. Forget about hundreds. An average across 10 companies, 50 companies is more precise than a single regression beta. So that takes away the standard error problem. Second, you pick the business mix. You can reflect the business mix your company is in today, even be proactive. So it fixes the business mix problem. And third, you can reflect the fact that, when you're looking at a company, it could change over time, or a private company, you can come up with a beta for the company. So at least set up the template. Today, I want to try the template out in a couple of companies. And along the way, I'll talk a little bit about the mechanical challenges you might face in doing this for your company, assuming you've picked a company. Here, I've tried to estimate a beta for Vale using this bottom-up approach based on the business itself. So I'll go to Vale's annual report. They break, and this was in 2018 or 19. They broke themselves down into 4 businesses: metals and mining, iron ore, fertilizers, and logistics. So I'm not making up this business mix. Most companies, if you look at their annual report at 10K, will give you their business mix. I went and found as many publicly traded companies as I can in each of these businesses. So metals and mining, I look for companies that were publicly traded in the metals and mining business with a market cap at least of $1 billion, because I wanted to get larger companies, not tiny metals and mining companies. There were 48 companies in my sample. I computed the unlevered beta for those companies. Remember, I have the regression betas for 48 companies. I average them out. I clean up for the debt to equity ratios of these companies. So I'll get the unlevered betas for each of the 4 businesses. You can see the numbers of companies I have is with fertilizers. It's immense, 693 companies. Those are the unlevered betas for the 4 businesses I'm in. I know how much Vale gets its revenues in each of their 4 businesses because they tell me that in their annual report. I take the revenues and add one additional step. In theory and in practice, you'd like your betas for a company to be a weighted average with the weights reflecting the values of each of the businesses you're in. Values, not the revenues. So I take the revenues and I multiply it by what's called this multiple called enterprise value to sales. It's a fancy word for what is the typical metals and mining company trade for. So I took the 48 companies, and across those 48 companies, it looked like companies traded about 2 times revenues, 1.97 times revenues. I took Vale's revenues, multiplied by 1.97, I get an estimated value for the metals and mining business. I do that for each of the 4 businesses. That's what I use to compute weights for the 4 businesses. As I saw it, when I valued Vale at this time, they're about 76% iron ore, about 17% metals and mining, about 5% fertilizers, and about 2% logistics. The weights obviously add up to 100%. The weighted average across those 4 businesses is 0.844. Instead of using a single regression beta, this now becomes my unlevered beta for Vale. And if I apply the debt to equity ratio for Vale as a company, I can come up with a levered beta, not just for Vale as a company, but for each of the 4 businesses. And I'm valuing Vale. This is the beta you're going to see, the 1.15, the levered beta that I get from building up to a beta from the businesses they're in. Again, the benefit is this beta is going to be far more precise than a single regression beta. It's going to reflect the 4 businesses they're in, and I have an added bonus. At the time that I did this, Vale was thinking of selling off its logistics business. Let's say I put you in charge of valuing the logistics business for sale. To value the logistics business, the beta I would use would be the 1.02 that you see for the logistics business. I can value individual divisions, I can value entire companies, and I've got a more precise beta that I can build around the company. So I'm going to pause there and let you think through the mechanics that you will have to go through for your company. You'll have to find the business mix, right? Whatever, 3, 5 businesses. Some of you might end up with a single business company. Now, if you look at Snowflake, for instance, Matt, probably one business, software, you can say that's my business cloud software, business software. You look for other business software companies, you come up with a beta, you unlever, you're pretty much done. You don't have to break down businesses. But if you're doing more complex companies, you probably will be in more than one business. Justin?
2 questions. So why are you only going after the companies that have the biggest market cap? Because if they're even
No, it's not even, 1 billion is not even a big market cap. In the mining business, if you look at below $1 billion, you're getting real. It's not really that I'm screening for really big companies. I'm screening out really small companies. $1 billion in market cap is a small market cap in the metals and mining business. A lot of those tend to be what I call junior miners, which are companies which really haven't figured out how to make money yet. So
Mhm.
that's why you see that screen only for metals and mining is I don't want to get those junior miners in there with very different stages in the life cycle into my mix. So
So-
again, it might be specific to a sector. You might decide to go with all companies. I don't have a problem with that. I'm just trying to remove the smallest companies in the mix because they have different
Different
fixed costs
profile.
and different stages in the life cycle.
But the beta doesn't have to be weighted, obviously.
No, I don't want to use a weighted beta because then I use the averaging advantage. Law of large numbers works best with simple averages.
And what's
I
the
don't want to use a
downside?
market cap weighted average.
What's the downside of averaging the levered beta instead of the unlevered beta? If like those businesses all kind of have the same like
I
debt.
started with an average. That's what I started with. I averaged the levered beta, then I averaged the debt to equity ratio. If I just use the levered beta without adjusting for changes in leverage, I'm assuming that every company in that business has the same debt to equity ratio.
Okay.
So if my company chooses not to have debt, I want to have the option of adjusting its beta for the fact that it chose to have no debt.
Okay. Thank you.
So if you want to use my betas by business, at the start of every year, I update this for 100 different industries, feel free to do so. But I think it's a good idea for you to at least get your hands dirty, try to get 10 or 15 companies like your company, do the averaging, do the unlevering, because it's a process that I want you to get comfortable with, even if you use somebody else's estimates of unlevered betas. Now, a couple of mechanical components to what I just did. Now, and I'll use Embraer, the Brazilian aerospace company, to illustrate this process. It's a Brazilian aerospace company. So I wanted to get a beta based on the business it's in. You know what I started with? I looked for other Brazilian aerospace companies initially. The problem I ran into is there's only one Brazilian aerospace company. Its name is Embraer. That didn't help me much. Then I tried Latin American aerospace companies. There's only one company in my sample. It's called Embraer. At that point, I stepped back and said, why am I putting a geographical constraint for an aerospace company? This is a business where Embraer competes with Bombardier, a Canadian company, with Boeing, a US company, with Airbus, a European company. It's a global marketplace. It sells to exactly the same airlines that those other airlines are selling to. Why don't I use an average across global companies? The law of large numbers requires large numbers. And if you stay constrained within a market, you might have trouble getting those large numbers, especially if your market is a market like the Portuguese market, which is like less than 100 stocks listed on it. There's no reason why you cannot compare betas across countries, because the average beta in every market is one, no matter how risky or safe a market is. So with Embraer, I went with the average of global aerospace companies. And if you saw with Vale, I used the global average. So I have a question about doing that. And I want you to think about the drivers of betas, right? How discretionary the product, what are your fixed costs, how much have you borrowed? Think about those three questions. Can you think of a scenario where you might choose not to use the global average for your company? And if so, what are the conditions under which you might decide to stay with a narrower definition of geography? What kinds of companies might you not want to use a global average?
Commodities.
Commodities, actually, I'd be more inclined to go with global averages because they sell into a global market, right? Oil companies. So in a sense, commodity companies are actually the easiest ones because they all play by the same set of rules. Rachita?
Like companies that have very localized businesses, so that are not functioning globally, then it would not be comparable.
Dude, not even localized, but remember the drivers of betas as how discretionary is a product. What are your fixed costs? What's your debt? If you have a product that is discretionary in your market, but non-discretionary in the rest of the world, you got to be careful about using a global average. I'll give you an example. Until about 10 years ago, when I did betas for telecom companies in emerging markets, I would rather than use a global beta, I'd use a beta for just emerging market telecom companies. And here's why. At that time, telecom in developed markets had become a non-discretionary product or service. Everybody had a phone, but in much of the rest of, if you took poorer countries, less than a third of the market or less than a third of the population had phones, and if the country did well, more people would get them. It was more of a discretionary product. My concern was if I used a developed market telecom beta to value an emerging market telecom company, I'd be underestimating the beta. That's one scenario. The second is when you have a heavily regulated business where the regulations vary across the world. Banks, I try to stay geography specific. US banks, I try to use a beta for US banks, European banks, because the regulatory rules for banks vary across the world, and that might cause the betas to vary. Most of the time, though, I have no problem using global averages. AJ?
So I guess when you're looking at a business that has like a telecom company, for example, like you mentioned, if it's a global telecom company that has operations in the US, maybe in Africa and in Europe, how do you value that total business if the beta is going to be very calculated very differently in each place?
Consolidate them all and use a weighted average beta, right? You can have a developed market telecom beta, an emerging market telecom beta, weight them based on how much you get from each. The other is, can you value different geographies separately if you wanted to, if you had the information? Yeah. If you really are concerned about differences across the world on every dimension, we'll talk about this more as we get further into class. It's called the sum of the parts valuation. You value different geographies, giving very different betas and growth rates and other characteristics to each geography. So leave that door open if you feel doing it on a consolidated basis is going to get really messy. So that's one mechanical detail, is this global versus. So if you go to my website, I report betas for the 95 industries that I track globally. I report them for emerging markets. I report them for Europe. I report them for US. I report them for Australia, New Zealand, and Canada. And I report them for Japan. So, and I report them for India and China individually because there are enough companies in each of those markets for me to be able to do that. I'm not suggesting all 8 should come into the mix, but you can then decide for a particular business whether you want to stay focused within a geography or look at the global average. Here's a second issue that you might run into. Now, when I talked about debt to equity ratios, clearly there's a debt number in the numerator and an equity number in the denominator. Both are supposed to be current market value numbers. For the equity, that's not a big deal, right? It's market cap, share price times number of shares. The debt, though, you can measure either as gross debt or net debt. You see, what's the difference? Gross debt is what you see on the balance sheet, the total debt due, all interest payment, interest-bearing debt. Now, we'll talk more about, but that's what you see on the balance sheet. You know what net debt is? It's that number netted out against the cash balance you have as a company. So you've got 100 billion in debt, and you've got 100 billion in cash. Your net debt is 0%. Now, remember, we talked about levering betas. I use the gross debt to equity, but there are people out there, especially in Europe and Latin America, where when they talk about debt ratios, they're talking about the net debt number, not the gross debt number. I'm going to say something that's going to sound incredibly weird, but I'll explain why I can get away with it. I don't care which one you use as long as you stay consistent. Let me take Embraer again as an example. Their gross debt to equity ratio is 19%, the total debt divided by market cap. And using that gross debt to equity ratio, the beta that I got was 1.07. If you go to the previous page, the unlevered beta is 1.0 was 0.95. The 18.95% I used was the gross debt. Levered beta that I get is 1.07. But if I did the net debt ratio, I get a negative number. Does it strike you as strange? When would you get a negative net debt ratio? If your cash exceeds your debt. Do you think that's unusual for cash to exceed debt? Matt,
No.
I can predict safely that you're going to get a negative net debt ratio. You know how I can? Young software
They're growing.
right? They're growing, they don't borrow money, they have a cash balance. In fact, the Mag 7, not young, these are the biggest tech companies in the world. Do you know that 6 of the Mag 7 stocks have negative net debt ratios? Apple has negative net debt. Google has negative net debt. I think, what do I do now? Stay with it. Use that negative net debt to equity ratio. And as I said, it's going to feel counterintuitive, weird, but you got to keep with it. come up with a levered beta using a negative net debt to equity ratio, and you're going to end up with a levered beta that's actually lower than your unlevered beta. Why? Because, go below zero, your levered beta is going to reflect that. Now, if I just stop there, it looks like I'm going to get very different costs of equity using gross debt and net debt, right? I'm going to get a much higher cost of equity using a gross debt to equity and a much lower cost of equity using a net debt to equity. But remember, your cost of equity is an ingredient in your cost of capital. If I stay with the gross debt to equity ratio, or the gross debt measure, I'm going to come, when I get to the cost of capital, have a weight of 85% for equity, 15% for debt, and come up with a weighted average of cost of equity and cost of debt. And remember, the cost of debt is much lower than the cost of equity. So when I do the cost of capital for Embraer using a gross debt ratio, my cost of capital is actually going to be much lower than my cost of equity because the debt is going to weigh it down. But if I stay with my net debt ratio and come up with a low cost of equity, that cost of equity is now going to a cost of capital calculation as well. But there, the net debt ratio is actually going to be negative. My cost of capital is actually going to be higher than my cost of equity. And if I do this right, I will end up with the same cost of capital, roughly speaking, for the company using either gross debt ratios or not net debt ratios. Now, if you don't even understand the distinction, just stay with gross debt. It's the way we compute debt ratios. But if you feel more comfortable using net debt ratios, all I'm saying is I'm completely okay with that as long as you stay consistent with it. Use a net debt to equity to get the levered beta. Use a net debt ratio in your cost of capital, and don't try to do weird stuff just because you have a negative number. Leave the negative number as is, and you should end up with roughly the same cost of capital as I do. So any questions about gross debt versus net debt? So basically, I'm taking the debt, netting it out against cash, coming up with the net debt ratio. Either will work as long as you stay consistent. So I think we're ready to wrap up cost of equity. So let's review. You need a risk-free rate. What's the risk-free rate? Depends on what currency you choose to do the valuation. We need an equity risk premium. You can always look backwards like many people do, but backward-looking premiums are going to get you in trouble when the world has shifted under you. So we came up with an implied equity risk premium approach, adjusted for country risk if need be. And for the beta, as I said, I'd prefer that you focus on a bottom-up beta rather than pull it off Bloomberg or run a regression, because this is your beta. This is what you're using to compute the value of your company. I think to take ownership of it, it's better to break a company down to businesses and build up to its beta. So any questions about any component of that cost of equity calculation? Risk-free rate, beta, equity risk premium, each carries its own choice. The risk-free rate carries your currency choice. Your equity risk premium reflects where you do business. Your beta reflects the businesses you're in. Don't mix and match, don't double count, because that's the pathway to getting into trouble. Kandar?
When we were calculating implied equity risk premiums, then we learned that we can take the historical averages because the standard error is going to be less. However, does that solve the problem when we faced with ERP? I think that we can't use the historical risk premiums because of the fact that there might have been systematic changes in the market. So
Kandar,
is that not the case with implied equity risk premiums?
Who made the choice of averaging the implied premium out? You did, right? So if you feel the world has shifted, let's say you're in 2009, you say, look, the world shifted last year. Then I think the choice is don't average out. Nothing should ever be on autopilot. There might be a rule you follow until you say, you know what, that rule doesn't work anymore, because you always have the choice with just going with the current premium. Nobody forces you to average things out. And remember, the averaging out doesn't have to be 50 years either. It can be 5 years or 3 years. You don't need that much time to average out when your numbers are not moving that much. But if you feel the world has changed under you, the safest thing to do is just go with the current premium. And that way you're not faced with this, did the world change? Have I fact? No, right after COVID, who knows what the world would look like after it? So I stuck with the implied premium, even though it looked high, because I said, this is the world I'm in. I'm going to value companies in the world I'm in.
Got it. Thanks.
Let's complete this cost of capital discussion, because all of this discussion about one way you can raise capital, which is through equity. You're saying, what if I borrow money? The two things I want to deal with here. One is I want to talk about what should go into debt in a cost of capital. And second, I want to estimate a cost of debt for that capital. So let me state what I'm going to be looking for in the cost of debt. The cost of debt is the rate at which my company can borrow money long-term today. Let me repeat that again. The cost of debt is the rate at which my company can borrow money long-term today. Two keywords there. One is long-term. So you can tell me you have 6-month debt and 1-year debt and 2-year debt. I'm going to act like you have 10-year debt. Why? Because this is a long-term opportunity cost. So I'm going to replace all your debt with 10-year debt. What does it today mean? I mean, when you look at an actual company, it's got debt on its books, right? It took on 2 years ago, 4 years ago. In fact, many of you have companies which took on long-term debt 4 years ago. What do you think the interest rate on that debt would look like relative to interest rates today? What were rates like 3 years ago?
Very low.
Very low, right? And I've seen people then take that and use it as a cost of debt. You cannot do that. You have to act like you're borrowing money today, which means to get to a cost of debt, I'm going to start with the same risk-free rate that I started the cost of equity with. The T-bond rate, if you're doing it in US dollars, the Turkish lira risk-free rate if you're doing lira, and add a default spread on top of it. You know what a default spread is? Basically, when lenders lend money to a company, they can't lend at the risk-free rate. Why? Because there's a chance that you will default. More in some companies than others, the default spread captures what they would charge over and above the risk-free rate. So how the heck am I going to get that? It is actually a much easier number to get than a beta or an equity risk premium. Here's why. If you're lucky, and many of your companies, you might get lucky, there might be an outside entity doing the dirty work for you, assessing the default risk in your company. I don't want to be mysterious, but if your company has a bond rating from Moody's or S&P or Fitch, somebody else has done the dirty work. There's a price there, which is you got to trust the ratings agency. So if I tell you that Moody's has rated your company BBB, or S&P has rated your company BBB, you have the basis for estimating a default spread because we know what the default spreads are for BBB rated bonds in the market today. So if your company has a rating, don't go looking for trouble. Take that rating, come up with a default spread based on the rating. I'll give you a lookup table, add it to your risk-free rate. You're done. You think, what if my company doesn't have a rating? We'll explore what to do about that, but here's what you need to do if you don't have a rating. You need to act like a ratings agency. And luckily for us, ratings agencies are among the most transparent organizations in the world. Sounds like a weird thing to say. It's not because they want to be transparent, but because of what they tell us. You look at Moody's and S&P, the output from the ratings agencies, they give you the rating for every company they rate. I think right now, Moody's and S&P rate more than 5,000 companies. They give you the rating for all 5,000 companies. Incidentally, for those of you who access Capital IQ, you can download all 5,000 companies and their ratings right now. They then give away the game. They give you the 8 ratios they claim to look at to come up with these ratings. So about 30 years ago, I said, look, I want to be like a ratings agency. I want to attach a rating to a company. So here's what I did then. I downloaded the rating for every rated company. And that time, there were only about 1,500 rated companies. I downloaded the rating so think of it as a gigantic Excel spreadsheet. Name of the company, I have the rating for each company. And then I downloaded the 8 ratios they claim to use to come up with the rating. And then I did some reverse engineering. You might say, well, what does that even mean? I sorted the companies based on ratings from AAA down to C. And I looked to see what ratios seemed to be explaining the difference in ratings. I was trying to reverse engineer what the ratings agencies were doing, but looking at the 8 ratios they claimed to look at and the rating they assigned. And here's what I found, and it's stayed pretty stable since. Of those 8 ratios, 1 ratio seemed to be carrying the bulk of the load and explaining differences across ratings. And the remaining 7 were just along for the ride. The 1 ratio that seemed to explain ratings best, and this is for non-financial service companies, is called the interest coverage ratio. If you remember your accounting, it's earnings before interest and taxes or operating income divided by interest expenses. As a lender, you want that ratio to be as high as possible. So in the case of Embraer in 2003, you divide their average operating income over time by the interest expense they had, you come up with an interest coverage ratio of 3.56. For every dollar in interest expense, they make $3.56 in operating income. If I can somehow take that interest coverage ratio and convert it into something that looks like a rating, you'd be home free, right? So starting 30 years ago again, I started creating a lookup table where if you told me what your interest coverage ratio was, I could guess your rating. So the way to read this table is the first column is for interest coverage ratios for larger market cap companies. You notice larger market cap companies need to have a lower interest coverage ratio to get a higher rating, and smaller market cap companies. And what I'm looking for is where in this table you would fall. So let's take Embraer. Embraer has an interest coverage ratio of 3.56. It's a large market cap company. At the time I did this, the market cap was about 11 billion. I go looking at this column, there's 3.56, between 3 and 4.25. The rating that I give them is A minus, and at least in 2004, the default spread based on the rating is 1%. So compute the interest coverage ratio. If the market cap is less than 5 billion, stay with the small market cap. If it's greater than 5 billion, go to the large market cap, come up with the synthetic rating, and come up with the default spread. So if you actually have a rating, don't do this. Just use the rating. If you don't have a rating, you can use the interest coverage ratio to come up with the rating to come up with the default spread. And with Embraer, I'm almost home. Let me explain why I said I'm almost home. It's not fair, but if you're a company in an emerging market, Turkey, Brazil, and Indonesia, then you carry two burdens on your shoulder. One is your default risk as a company. The other is the default risk of the country. Put simply, if you're a Turkish company now, you're borrowing at a much higher rate, not just because you're risky as a company, but because you're in a risky country. Your cost of debt reflects some country risk, just like your equity risk premium does. So to get the cost of debt for Embraer, I start, because I'm doing everything in US dollars, I start with the dollar risk-free rate, 4.29%. I add the default spread for Embraer as a company, but I also add a portion of the country default spread for Brazil. Why a portion? Because Embraer gets a lot of its revenues in US dollars. It's not as exposed as the typical Brazilian company. The cost of debt that I have on a pre-tax basis as Embraer is about 9.29%. If you're doing a US company, just the company default spread. But if you're doing an emerging market company, you might have to bring in some or most of your country's default spread into the equation, which is going to push up your cost of debt. Rahul?
Sorry, I have two questions.
Go ahead.
On the previous slide, what was the second column?
That's for smaller companies. So basically, if you're a small company, you need to have a much better interest coverage ratio to get the same rating, because ratings agencies seem to treat smaller companies more strictly than larger companies. So the first column is if you have a market cap greater than 5 billion. The second column is the lookup table if you have a market cap less than 5 billion.
Got it. And then my second question is, when you factor in the default spreads into the cost of debt, are we not also double counting because in the end with the cost of capital, because we counted for the default spread in the market
But
risk
remember,
premium as well?
What do you weight the cost of equity and the cost of debt by? Let's say you have 80% equity, 20% debt. Do you see why it's not double? If you did not do it, you'd not be counting it enough. So the reason you're not double counting is they're weighted by how much of each you use.
Got it.
Okay.
Okay. Thank you.
Now, I use these synthetic ratings around the world on, Turkish lira bonds, and people often ask me, this table was constructed at the time that I did this originally was constructed with just US companies. Now it's a much bigger sample. I have emerging market companies, I have European companies, but it's still more developed market companies and, emerging market companies. So I'm often asked, am I okay using this lookup table for companies in countries where very few companies are rated? And I have no problem doing it. But the one caveat I would add is these default spreads work best if your risk-free rate is roughly similar to mine. So if you're in a country with a 5% risk-free rate, I'm okay. 6% I can live with. But if your risk-free rate is 15 or 20 or 25%, then I think the table is going to understate your default spread. Do you see why? If I'm charging a 3% default spread on a 4% risk-free rate, that makes sense. But then if your risk-free rate is 40%, I'm not going to settle for a 3% default spread anymore. I might have to scale it up. So again, with really high risk-free rates, that risk premium will also have to get scaled up to reflect the fact that your risk-free rates are much higher. But most of the time, you can just take this table, use it in another currency and get away with it, even though it was constructed originally using US companies in US dollars. So the big number then in your cost of debt is your default spread, right? Can default spreads change over time? Of course. Why? Fear and greed. The same forces that cause equity risk premiums to change over time will cause default spreads to change over time. We go back to 2022. 2022 was an incredibly painful year for companies and investors for two reasons. One is the risk-free rate went up. Remember, the T-bond rate went from 1.5% to almost 4%. But at the same time, risk premiums went up. I showed you what happened to equity risk premiums in 2022. They jumped from 4.3% to start the year to 5.94% by the end of the year. Why? Because people were scared. What were they scared of? Inflation. Those same forces that caused equity risk premiums to rise also played out in default spreads. This is in 1 year. Let's take a rating of BBB. When you started the year, your default spread was 1.21%. By the end of the year, that default spread had become 1.87%. If you were single B rated, you started the year at 3.51%, you ended the year, your rating did not change, but your default spread widened. For the same reasons equity risk premiums change over time, default spreads widen over time. I have on my website the default spreads as of the start of 2024. But if I'll send you a link in my email today if you want to get a more updated default spread number, because they haven't changed much between January 1st and today, but who knows what they will look like by April if something crazy happens. So I'll give you a way of updating default spreads as you go through time because you want to get the most updated number you can. So risk-free rate plus default spread is the cost of debt, but it's a pre-tax cost of debt. You're saying as opposed to what? With the cost of equity, you had only one cost of equity. There's no pre-tax or post-tax. But with debt, there's a pre-tax cost of debt and a post-tax cost of debt. Alfonso, why is there a post-tax cost of debt? What is it about debt that makes it?
Post-tax cost of debt, because you still have to pay the tax on the interest.
Actually, it's the opposite. It's when you pay interest,
right,
you actually get a tax benefit.
Oh, right, exactly.
Right?
Yeah, that's the tax shield.
And
yeah.
With equity, why don't we have the same thing with equity?
What about equity?
Why don't we have a post-tax? Because with debt, we multiply by 1 minus the tax rate because you get the tax saving. Why don't we have a similar calculation with equity?
Because whatever the business produces goes to the equity holders after you pay taxes, regardless of how much.
And who wrote this tax law, Alfonso? Because this is coming from the tax
law,
law, right?
Each state. Yeah.
The legislators do it. So the same guys who complain about companies borrowing too much money have written a tax code that encourages them to borrow money. I've never understood this hypocrisy. No.
Well, I mean, I feel like, the incentives of their own company would balance out. Like, I mean, there's obviously an incentive to,
But you've added to the incentive
yourself, but there's
by
also
giving them a tax benefit. You've really made them borrow more money, right? Without the tax benefit, they wouldn't be borrowing anywhere close to what they are.
Right. I mean, you're optimizing for the optimal amount of tax related.
As the legislator, you should be optimizing your tax revenues, right? So why are you encouraging companies to borrow and creating all these side costs for society? I'm not expecting you to answer because I think it's
Philosophical, yeah.
it reflects a century of tax law that reflects a very different world, where the railroads needed to borrow money to build the railroads in the US. So the tax law was created for the railroads. And once it got in there, you can't take it out. Too many businesses are built. You would kill real estate as a business if you took away the tax benefits of debt. Okay?
So, Professor, a quick question, if I may. Yeah. So, let's just say I'm a lender to a company, and when the company pays me interest, I will have to pay tax on that. But if we expect the company to pay the tax as well, wouldn't that amount be double?
Wait. So you're asking why am I, because the two are separate issues, right? When you pay dividends to another company, so let's remember companies own shares in each other. When you pay a dividend, is that dividend taxed to you when you get it as income? Absolutely. So this is the double taxation is an issue we can talk about, right? That's an issue that arises in multiple domains. That really can't explain why you have this selective tax benefit. It's really not, that I have an issue with the tax benefit debt, but why debt and not equity? Because you're creating an imbalance in the system that's going to encourage companies to borrow more than they should. But for better or worse, you do get a tax benefit, which means the way you compute a post-tax cost of debt is you take your pre-tax cost of debt, risk-free rate plus default spread, and multiply by 1 minus a tax rate. You're saying, where do I get a tax rate? The tax rate you will see in the financial statements is called an effective tax rate. The effective tax rate, very simply, is taxes paid divided by taxable income. So you go to the income statement, you take the tax line item, you divide by taxable income, you come up with an effective tax rate. That tax rate, on average, globally last year was about 18 to 20%. So the typical company pays an effective tax rate of 18 to 20%. That's not the tax rate you should be using in computing an after-tax cost of debt. Strange, right? You're saying, if I calculate, why shouldn't I use it? Remember how interest works for you when it comes to doing taxes. I have to do my taxes soon. Let's say you have $1 million in income. If I'm insulting you by understating your income, add an extra zero if you want. Let's say you have $1 million in income. Let's say you have $200,000 in interest expenses. So how does this work when you have 200,000? You subtract the 200,000 from the $1 million in income. You report $800,000 as your taxable income. You pay taxes on the 800,000, right? Everybody with me so far? Think of where you saved on your taxes. It was not in the first 200,000. It was not in the middle 200,000. It was on the last $200,000. You might still be mystified. So what? The tax rate you pay on your last dollars of income is called your marginal tax rate, as opposed to the effective tax rate, which is an average tax rate. The marginal tax rate is what you pay on the last dollars of income. If you're a US company, a publicly traded company, remember the tax brackets kick off very quickly. You're in the very top tax bracket almost right away. What does your marginal tax rate look like as a US company? Ryan, do you have a sense of what the marginal tax rate for US companies right now? And if you make $1 of income?
I think it's right around that 20% that you were talking about.
If you look at federal tax, it's 21%. It used to be 35. It was brought down to 21% with the 2017 tax law. But the US has this strange system of state and local taxes as well, right? So if you're a New York state-based corporation, you pay state taxes, local taxes. Roughly speaking, a US company pays about a 25% marginal tax rate. When I compute the cost of debt for Apple, I'm going to take the pre-tax cost of debt and multiply by 1 minus 0.25, which is the marginal tax rate, not the 16% that Apple actually paid as an effective tax rate. You might not believe this, but I've actually made your life a lot simpler, because when I ask you to compute the after-tax cost of debt for your company, you don't need to go digging through the financial statements. You just have to find the country in which your company is incorporated and look up the marginal tax rate that goes with that country. If you go to the spreadsheet, the valuation spreadsheet that I sent, you as a link, last Wednesday, if you get a chance, take a look at it. In one of the worksheets, I have the marginal tax rate for every country in the world. So you can pull the tax rate, use that in your cost of debt. You're pretty much done. That is your after-tax cost of debt. But first, before I leave this, I want to make sure everybody understands why marginal as opposed to effective, because interest saves you taxes at the margin. That's why we want the marginal tax rate. I don't care how low your effective tax rate is, you'll find a way to get your marginal tax rate as your benefit. And second, finding those marginal tax rates. So basically, it comes right out of the tax code. This is in theory, it's not abstraction, it's actually from the tax code. Any questions on the use of tax rate? Justin, go ahead.
Why again are you using 25 and not 21? I'm a little confused.
Because we have state and local taxes. A typical US company almost never gets away with a 21% tax rate. So that's just your federal tax rate.
Okay.
But there's state and local taxes on your corporate income as well. In California, we're closer to 27% for the typical corporation. 25% is what a typical US company pays. Yeah.
Is it that a portion of the state income tax is deductible?
It could be. So if you want to actually dig deeper and say they're a Texas-based company, it's going to be closer to 23, you can, but I don't think it's worth the hassle, because it'll vary across states depending on where you're incorporated.
All right, thank you.
Parikshit?
Yes, I just wanted to, so the marginal tax, where do you get it? Is it the
Comes right
10Ks
out of
or?
the tax code, right? So what part of the world are you're from India? Where are you from?
Yeah.
What part of the world are you thinking about when you think about marginal tax rate? The US, I told you it's 25%. So tell me the country you're in, and I can.
India.
The marginal tax rate in India is about 30%. It used to be 33.99%. So it comes right out of the Indian corporate tax code, right? The way I have corporate tax rates for every country in the world, I'd love to claim I did the hard work. I did not. I stole it from PwC. PwC last year actually went through the tax codes of every country. So there's some poor intern whose job it was one summer to go through every country's tax code, pulling the corporate tax rate. So it comes right out of the tax code. It's a tax rate. It's called a statutory tax rate because of that reason. It's a marginal tax rate. Did that answer your question?
Got it.
Okay.
Yes,
Now,
got it. Thank you.
a little bit of a tangent here. Once in a while, you might get a company that is able to borrow money at below market rates, subsidized debt. Now, I'll give you an example. Embraer actually has, and I don't know whether they've paid these off, had loans from the Brazilian government that lent the money at 6%, even though the market cost of debt was 9.29%. And government subsidized debt for lots of different reasons. Tesla used to have government debt that was actually well below market rates because the government wanted to encourage the production of electric cars. They paid off all that debt. So once in a while, you do have subsidized debt, which is debt at rates lower than your pre-tax cost of debt based on the default spread. So I have a very simple pragmatic question. Let's say you're valuing a company, maybe a green energy company that has subsidized debt. Remember, green bonds, to the extent that they actually work, deliver debt to you at below market rates. When I compute the cost of capital for this company, should I use that subsidized cost of debt, which is lower than the market rate? Should I go with the market cost of debt that I got from the default spread? Or is there some compromise solution that you can come up with that allows me to capture the benefit of the subsidy? Let's play it through. Let's suppose I use my subsidized cost of debt, which is 6%. I'll come up with a lower cost of capital, right? If I leave it at that number forever, what is the danger that I'm exposing myself to as an investor in valuing the company based on that cost of capital? What am I implicitly assuming about the subsidy? Rachita?
That it will just be lasting for the life of the company.
Forever, right? Basically,
Yeah.
I'm doing a perpetuity. And that's dangerous. We know subsidies don't last forever. So I don't want to go with the first approach because I'm going to end up with too high a value for my company. What about the second approach where I ignore the subsidy, go with the 9.25% that I came up with as a cost of debt? Actually, I'm going to stay with you. What will happen if I use that cost of debt? What am I?
Like ignoring the subsidy, Professor?
I'm ignoring the subsidy entirely. I think I've led you to the solution. So you don't want to use the first approach. You don't want to use the second.
I
Is
would
there some third approach? Go ahead.
try to value how many years the subsidy or how many periods the subsidy would last, and then
Okay.
use the cost of capital with the subsidy for that period, and then use the fair cost of capital for the rest
And
of the
in fact, you're doing something already that I think is healthy in discounted cash flow valuation, which is allowing the cost of capital to change over time because life changes, circumstances change. That's exactly what you should do. You use the subsidized cost of debt for the next 5, 6, 7 years, whatever the loan runs out. So if you're a company, the green energy company that's dependent on green bonds and people are lending you money at 2%, and that's fine. Live off the subsidy. You don't want to turn it away, but at the same time, don't value the company on the assumption that that subsidy will last forever, because it will not. So is everybody comfortable with that conclusion? If you have subsidized debt, there's nothing wrong with incorporating that subsidized cost of debt, but let it run out at some point in time, because no subsidy lasts forever. So we have a cost of equity, we have a cost of debt. Richard, your question?
Yes. So do you take in consideration when the operating company is different from where the parent company is incorporated?
Well, like Alibaba, for a long
Correct.
time is incorporated. It's where you pay, you pay taxes where you earn income, not where you're incorporated. So I think you're raising an interesting point, which is if you have a company whose operations are in China, even if they're incorporated in the US, the tax rate you should be using should be the marginal tax rate for China.
Okay.
Which is, it's unusual to have that separation, but if you do have the separation, go where your income is, because that's where you get taxed. It's not where you're incorporated.
Okay. Thank you.
Yeah. Rachita? I think her hand is up. So final piece, I have the cost of equity and I have the after-tax cost of debt. I need weights for the two of them. Yeah. How many of you are doing your CFA? Anybody here trying for a CFA? Matt, you're doing it? No. I've done the CFA keynote now for like 30 years. I've worked with them, and they were a small organization with a few thousand people taking it. Now, of course, they're gigantic, hundreds of thousands of people take it. And they have a problem. You know what the problem is? They've got to fail a lot of people to keep the CFAs in your high. So Matt is probably required to read like 7,000 pages of stuff he really doesn't need to read. And then it's a closed book exam where he's asked questions like, what was on page 7,755? And if he doesn't answer it, he fails the CFA. So I've begged them for a long time, saying this is not a healthy way to test somebody's understanding of valuation. Can you help me? Will you allow me to write the exam 1 year? My exam, there'd be only one question. If you get the answer right, you get all 3 levels right. So Matt, I'm going to give you a chance to get all 3 levels of your CFA unofficially from me. And here's the question. You open up any finance textbook and you look at the section on cost of capital, you're told that the weights you should use to weight debt and equity should be market value weights. It's almost like a religion. And that's true, you use market value weights. But remember, you have an alternative of using book value weights, which is book value of equity, book value of debt out of the balance sheet. Why? So my question is a very simple one. Why do we use market value weights to compute cost of capital? And I'll give you the choices. It's because the market is usually right, because market values are easy to obtain, because accountants have no idea what they're doing, or maybe it's none of the above. What do you think the answer is, Matt?
Because they're easy to obtain.
But book values, I mean, you open up a balance sheet, shareholders' equity is right there, right? Debt is right there. So I'm not sure easy to obtain is going to be the obvious answer. Anybody want to jump in? Anybody want to say it's because the market is usually right? That'll be a trap, because if you choose that, you're in trouble. And here's why. Use these weights to value the company. You compare the value to the price, and then you tell me the company is undervalued. And I'm going to come back and say, but you told me the market's usually right. So don't go down that route if you're doing an intrinsic valuation, because you're going to get trapped. It's not because the market is usually right. It's not because market values are easy to obtain. I hate accounting rules and what they do, but I don't think C is fair either. It's not completely random. There are accounting rules that drive there. Here's the reason. Every discounted cash flow valuation is an exercise it's an exercise in hypothetically acquiring the entire company today. If you acquired the entire company today, guess what you'd have to pay? Today's market price for equity. Alfredo, is the answer you're going to come up with?
Yeah.
You get all 3 levels of the CFA. So I'll send you the certificate
you.
later after class today. CFA 1, 2, and 3. We use
Thank you.
market value weights because that's what it would cost today to buy the entire company. That's it. It's not because the market is right, but it's what you have to pay. Today, if you decide to acquire NVIDIA, guess what? You'd have to pay $700 per share, even if we thought the stock was worth $400. So we use market value weights because that's what you have to pay. So it took me a while to do this with Embraer, but let me pull all the numbers together on Embraer. For the cost of equity, and this was in 2004, I chose to value Embraer in US dollars. Notice the word I used, chose to. Why? Because in 2004, there were no 10-year real denominated bonds of the Brazilian government. I could not even get a risk-free rate in reais, so I chose to do the valuation in US dollars. Where does that show up? Just in the risk-free rate. That's the only place currency shows up. I use the US T-bond rate as my risk-free rate. The beta that I used for Embraer was the bottom-up beta that you saw, 1.07. And I did compute a lambda for Embraer. I don't know whether you remember, but 2 sessions ago, I ran a regression of Embraer's stock price against the country bond, 0.27. Risk-free rate plus beta times mature market premium plus lambda times country risk premium for Brazil, huge in 2004, gave me a cost of equity of 10.7%. For cost of debt, I did exactly what we just described at the start of class today. Risk-free rate plus default spread for the country plus default spread for the company, 9.29%. I did multiply the pre-tax cost of debt by 1 minus the marginal tax rate for Brazil, which was 34%. It's still, I think, 34%. For the weights, I use market value weights. Market value of equity, which is 11.042 billion reais. Market value of debt, 2.08 billion, giving me weights of 84% for equity, 16% for debt. My weighted average cost of capital is 9.97% for Embraer in US dollar terms. So in a sense, you can see risk-free rates, betas, default spreads, equity. This is the end game. This is what you're going for in that D in your discounted cash flow valuation. Keep your eyes on the price. Don't get distracted by small things that are not going to cause your cost of capital to change by much. One final point, usually getting market value of equity is easy for a publicly traded company. Share price times number of shares. Getting market value of debt is a bit of a nightmare because debt is usually in book value terms. I'm going to give you a neat little trick you can use to convert book debt to market debt. At the time that I did this, the book debt for Embraer was 1.95 billion reais. The interest expense was 222 million. And the weighted average maturity when the debt came due was 4 years. So this was all in the financial statements. Interest expense from the income statement, book value of debt from the balance sheet, and the weighted average of maturity of debt from the footnotes. Here's how I converted book debt to market debt. I acted like this debt was one gigantic coupon bond with a coupon of $222 million a year each year for 4 years. So that's why the present value of an annuity, plus a face value 1.95 billion at the end of the 4th year. That's a book value of debt, discounted back at the 9.29% pre-tax cost of debt. That's from there. What I get as a present value is 2.08 billion reais. I know a lot of bankers do a dance and they say, I'm going to use book value as market value. Most of the time, you're going to be okay, but this is a much cleaner way of converting everything to market value. You get weights that reflect market value weights, and that can become your cost. So that is my dollar cost of capital. Now, let's say you did this for your company, you decide to value a Colombian company in dollars, you get to April and you change your mind. You want to do everything in pesos. There are 2 ways you can convert your cost of capital from reais or pesos into dollars. The first is start from scratch with a different risk-free rate. Doable, but it'll take you time. The second is you can take your dollar cost of capital, and remember what we talked about currencies, the only reason they matter is because they bring in different expected inflation rates. If the Brazilian inflation rate is 8% and the dollar inflation rate is 2%, you can scale up your cost of capital for the additional inflation. So, if you're in a hurry, just add 6% to the 9.97%. You come up with a cost of capital in real terms of about 16%. You can go between currencies with this neat trick. And it's a great way to convert from one currency to another in terms of cost of capital. It'll allow you to convert a cost of capital in one currency to another. Couple of final points about cost of capital before I put this to rest. I mean, so far when I talked about cost of capital, I talked about debt and I talked about equity, and everything fell into those two buckets. But there are companies, and your company might be one of them, which issue what are called hybrid securities. You know what a hybrid security is? It's part debt, part equity. I'll give you two examples. One is convertible bonds. A convertible bond, the debt part is, of course, the debt and the convertible debt. The conversion option, which allows you to convert your debt into equity, is really equity. My advice is when you have hybrid securities, try to break them down into debt and equity. And I'll give you a very simple way of doing it, but don't create a third component in your cost of capital. The preferred stock is a bit of pain in the neck. Banks sometimes issue, come back and talk about preferred stocks. That might be the one ingredient where you might have a third component. Your company is a company with a lot of preferred stock, and the cost of preferred stock is just the preferred dividend yield. It's a very simple calculation. But if you have convertible debt, break it down to debt and equity, and here's how you can do it. I'll take an example. Let's say you have a company which has a convertible bond with a face value of 125 million and a coupon rate of 4%. So basically every year you got $50 million or $5 million in interest expenses. But it's convertible. So the market value of this convertible bond reflects that conversion option of 140 million. To break this bond down, here's what I did. I took the debt part of it, which is the 5 million a year every year for 10 years, which is the coupon, and the face value discounted back. And in this case, if this company had issued straight debt, its cost of debt would have been much higher without the conversion option, 8%. The present value I get is 91.45 million. That goes into my debt portion of my cost of capital. The difference between the 140 million, the market value, and that 91.5 million, the 48.55 million, goes into equity. My convertible bond is off the books. They've gone debt and equity. So if you can, try to break hybrids down to debt and equity components, put them into the components, much cleaner way to deal with those components than trying to bring them into a third component in your cost of capital. So let's review the pieces for the cost of capital. The cost of equity comes from a bottom-up beta and equity risk premiums. The cost of debt is the rate at which you can borrow money long-term today, based on either an actual rating or a synthetic rating. The tax rate should be a marginal tax rate, and the weights should be market value weights. Kind of hold on to those thoughts, lots of different small pieces, but that's what you're aiming for when you think about a D in a discounted cash flow valuation and you're valuing the entire business. Any questions on cost of capital? Go ahead, Justin.
How do you handle again if the company has operations in multiple countries at multiple?
The only place it shows up is in your cost of equity through the weighted average equity risk premium. That's the only place it will show up.
What about the
beta,
marginal tax rate in those countries? In those separate
Don't
countries?
use a weighted average marginal tax rate, and that's the reason I wouldn't do it. Is if you're in multiple countries. Let's take Apple. Apple's a multinational.
Mhm.
It's in probably 60 countries around the world. You know where they borrow all their money? In the US. Why? Because you got a 25% tax rate. Because they don't want to borrow in Ireland and get a 12% or a 15% tax rate. So you will tend to see companies which are multinationals with equity. You have no choice because your operations are there. With debt, you decide where to borrow the money. And that's why you're probably going to be safe using the marginal tax rate of just the country they're in, even though they're multinationals.
Because the deduction you're saying goes with the country where you're borrowing.
Exactly. And you want to get the maximum deduction you can. So you tend to go with, if you're a US company, you tend to go with the US marginal tax because it's, right now the global marginal tax rates are converging around 25%. So we're around 25% no matter much of the world. But that's part of the reason the cost of debt becomes a much simpler calculation.
And I had one more question about you talked about the lambda method, and then you were talking about local betas, like for specific industries. They're kind of covering a similar concept, right? Like you wouldn't.
Yeah, and with the local betas, so if you're ever going to use local betas, avoid the lambda approach. It's just too many layers of complexity, right? Because then you're going to do lambdas by countries and betas by, so it's a mess if you start to do it too much on a localized basis. For 95% of companies, just go with the beta for the business, reflecting global averages, use a weighted average equity risk premium. The Lambda approach is for that exceptional company with a single country you're terrified about, and everything is being subsumed by that fear. So other than those cases, I would almost never use Lambda.
Okay. All right, thank you.
Talk about cash flows. Right? I'm going to at least set up the process because we're getting towards the end of the class. But if you remember, we talked about free cash flow of the firm and free cash flow equity. I'm going to set them side to side so you can see the differences between the two and what they're trying to do. With free cash flow equity, I start with net income. With free cash flow to the firm, I start with operating income. Let me pause right there. Why do I do that? Free cash flow equity is an after debt cash flow. Net income is after interest expenses. So free cash flow equity, I start with net income. Free cash flow of the firm is pre-debt. So I have to start with earnings before interest and taxes. I have to act like I pay taxes on the operating income. Why act? Because I actually pay tax on taxable income, but I act like I pay taxes on the operating income. So starting points are different for the two. One is net income, the second is after-tax operating income. From that earnings, I subtract out what I have to reinvest to grow. First, let me ask you a question. Do I have to reinvest as a company? Richard?
No, you don't have to reinvest.
And if you don't reinvest, what do you give up? Growth, right? So it's a trade-off. You
Correct.
decide whether you want to reinvest. And if you think growth is good, you reinvest. And what do you have to reinvest in depends on the company. It could be land, building equipment, machinery, capital expenditures. It can be acquisitions. Remember, acquisitions are just gigantic CapExes. Of course, some of it will be paid off with depreciation. But if you're a retail firm, you might have to reinvest in more inventory and more receivables as you're growing. So if you think about collectively what you reinvest, that's net CapEx, CapEx minus depreciation and change in working capital. I subtract that from my earnings for both free cash flow to equity and free cash flow to the firm. And then if I'm doing free cash flow to equity, I have one more loose end to tie up, which is if I borrow money, cash comes into the company. I know it sounds counterintuitive, but borrowing money is a cash inflow to equity investors. Repaying debt is a cash outflow. So I bring in those cash flows from debt repayments and debt issuances to get to free cash flow to equity. Net income minus reinvestment with this net debt cash flow gives me free cash flow to equity. After-tax operating income minus reinvestment gives me free cash flow to the firm. You're going to run into this concept of free cash flow constantly. If anybody says free cash flow and stops there, don't let them stop right there, because without telling me to the firm or equity, you've left me hanging. They're different. So you're going to run into this free cash flow to the firm and free cash flow to equity repeatedly across this class. And one of the things we're going to talk about is the sequencing. How do you get to free cash flow? In both these approaches, you start with earnings. And we'll talk a little bit about cleaning up after accountants, because your starting number is screwed up. Everything after that is going to be screwed up. You're going to subtract out reinvestment that you estimate for the company. And if it's a high growth company, it'll be a higher reinvestment. And then if it's a free cash flow to equity, you bring in the debt cash flow. Alfredo?
What about impairment of goodwill in operating expenses? How do I subtract them?
So if you have impairment of goodwill, you have high operating expenses. First, is that a non-cash charge or a cash charge?
It's not.
So what should you do to get to cash flows?
I will subtract it.
You'd add it back, right? Because
your
earnings are understated, you add it back. Any non-cash charge. And this is why impairment of goodwill is so useless from an investment standpoint, because it does nothing for you. It doesn't save you taxes. It doesn't affect your cash flows. So why do accountants waste their time doing it? Because it gives jobs to accountants. So I guess we should feel good about that. It's one of the most pointless exercises from a cash flow perspective, precisely because of what you do. Alfonso.
Okay. Yeah, I just wanted to go back to the slide 2 before. So net income equal to operating income minus taxes?
No, because you got interest expenses in the middle.
You have interest expenses in net income.
It reduces
net income.
Net income is lowered by interest expenses, right? So basically the way you get from operating income to net income is you take operating income minus interest expenses gives you taxable income. You pay taxes, you get to net income.
Right, but then in free cash flow to firm, why would you not deduct those taxes?
That's exactly the question I'm going to ask you. Why are we ignoring tax benefits? That's a good question. Why don't you tell me? Why are we ignoring the tax benefits from interest expenses when we do free cash flow to the firm?
Because part of the stakeholders of the firm are the debt.
No. What do we discount free cash flow to the firm by? What's the discount rate we use on the free cash flow to the firm?
The discount rate we use on the free cash flow to the firm, we use the total cost of capital.
And what goes into cost of capital? Cost of equity and
cost of debt.
After-tax cost of debt. Your
Okay.
tax benefits are already in your discount rate. If I added that tax benefit on to my cash flows, I'd be double counting the same tax benefit.
Right. So if you wanted to add, you know, to like use the same metric and have the tax benefits up front, then you would only use cost of equity. You wouldn't
Or
use
you'd use a pre-tax cost of debt. You
Right.
can't have it both ways, right? You have to decide, well, do I go with the discount rate adjustment for the tax benefit or a cash flow adjustment? You can't have both in the same because then you'd be double counting.
Okay.
Incidentally, I'm going to close with a couple of, because as you go through the past quizzes, and I'm going to send you the preparation stuff you can do to get ready for the next quiz, you're going to see this word free cash flow to the firm pop up. And you're going to see multiple ways I get there. So this is just plain breaking out how you can get to the same destination using 3 different routes. The first is what we just did. Take the after-tax operating income, net out reinvestment to come up with free cash flow to the firm. That's approach 1. That's what we did. I can also take this total number inside the brackets and just call it reinvestment. So whenever you see me use the word reinvestment in this class, I'm talking about the entire amount, net capex, acquisitions, all of that stuff built in there. Or I can take the reinvestment and scale it to my after-tax operating income as a rate. So I can say 40% of my after-tax operating income gets reinvested. I'm saying exactly the same thing. I'm just getting to it in 3 different ways. So as you look at past quizzes, you're saying, why does this guy keep using 3 different equations? It's the same destination. I'm just getting there using different ways, depending on how the problem is structured. So it's exactly the same free cash flow to the firm. And with free cash flow to equity, it's exactly the same free cash flow to equity again, depending on how I structure it. Ultimately, it's about looking at cash flows left over after debt payments. And that cash flow I can get to by either subtracting it out the way I did, subtracting out as an equity reinvestment number, or stating it as a rate. So as you go through past quizzes and you see these calculations, if you're getting confused about which one, pick one that you feel comfortable with and stay with it. Alfonso, final question, and we'll end for the day.
Okay. What? No. Yeah.
Do you have a question or your hand up from before?
Yeah, I had it from before. Yeah.
Okay.
Sorry.
So let's wrap up for the day. We're pretty much out of time. I will be sending out an email. I've already sent you the links to the review sessions for the quiz a week from today. I'll send you another email with the links again in case you did not read the last email, which I assume some of you are not doing. It's too long, too involved. But this email, please read because it'll set you up for the quiz. So I'll also send you links to the past quizzes, right? Every quiz I've ever written. My only piece of advice on past quizzes is if you're working through, don't start with the 1996 quiz, which is the very first quiz, and work forward. Start with the 2023 quiz, which is the last quiz, and work backwards. Because the material is a little different, and I'll tell you what in the earlier quizzes we don't cover on this quiz. So start with the 2023, 2022, 2021. Try to work through as many past quizzes as you can. You can use the solutions as a crutch, but have at least a couple of quizzes that you have as holdout quizzes. You know what I mean by that? Give yourself 30 minutes, try to see if you can do a quiz after you think you're ready. But I will also set up extra office hours on Tuesday next week when you might have questions so that you can, pop in. So I'll make it a 2-hour office hours. I'll make it as late on Tuesday as possible because I know some of you will not start preparing till Tuesday morning. So I'll make it probably 4:30 to 6:30. So I will send you the link for that, and I will see you in class on Monday. Take care.
Thank you.